Hi, everyone. Jared Levy here, Director of Investment Strategy here at DBHW, and really excited to bring you guys our Q3 recap. And we'll talk to you a little bit today about what we see coming up in the future. First of all, obviously, another record quarter in the books. Markets were led in a lot of ways by small caps, by smaller companies. Why? Well, small cap companies or Main Street, if you will, a lot of them tend to borrow money, right? They're growing, they're dependent upon loans, credit, so therefore interest rates impact them in a big way. So with interest rates now starting to turn down, which we saw the first of that in September, small caps have been booming. In fact, the Russell 2000 was a big leader. Now there's a really important distinction here I need to talk about. Quality is not important right now. I know that sounds crazy. To us, it is. But to markets, they've actually eschewed quality, and they are buying everything that's leveraged, everything that's, cheap, low quality. Why? Because they want momentum. These markets have been very momentum heavy, right? Tech has continued to lead. The Magnificent Seven has continued to lead. Obviously, just about any company associated with AI has seen tremendous strength for most of the year and continuing into the third quarter and here as we go into the end of the year. From an economic perspective, there's a lot of cracks in the foundations, okay? We're entering the fourth quarter right now. Below trend growth, sticky inflation, a complex backdrop, if you will, for stocks. And as much as we want to remain bullish, there are some things which give us pause, as we sort of look back, look at what's happened, and then project forward. Now, consumer discretionary has proven really strong. Industrials have proven very strong. You've heard us talk perhaps about our investments in AI, in infrastructure, in defense, right? When I talk about defense names, obviously, as we just saw the Israeli-Gaza conflict come to a close, hopefully permanently. Hopefully that region begins to rebuild and peace stays. But there are a lot of, hot spots. The U.S. has been ramping up its, tariff tit for tat with China, if you will. And we don't think that that's probably going to end anytime soon, even if they come to an agreement in the near term, which I hope they will. We obviously still have issues in Russia. We still have issues, all across the world. There are pockets of tension, but the biggest driver of defensive names, in our opinion, is really the fact that China is taking a much different stance on the world. They've assembled the BRICS nations, if you've heard that term before, and they are flexing their might against the U.S. And the U.S. has lagged for many, many years in building up our munitions, our defense budgets, et cetera. So we think that's going to continue to be a favorite for the markets. All right, so what are we looking at moving forward? Well, as I said, it's a complex landscape. I think real gross domestic product growth is probably going to be continue to decelerate, maybe to 1% or less. We actually believe that there are parts of the American economy that are in recession right now. But again, as a whole, we're not seeing that. Why? Because, people are spending. The tariffs have created sort of this unusual force for people to go out and purchase before tariffs got ratcheted up. And again, interest rates are coming down. We do think that the Fed will lower rates at least 25 basis points this year, but probably more like 50. And again, government's currently shut down, so we don't know what the current labor market looks like specifically. We can tell you that ADP data, some of the other suppliers of information are showing a not good situation out there. So that remains a big concern of ours, okay? And stocks right now are trading at a premium. Market valuations are very, very high right now. In other words, the price to earnings multiples, other metrics that analysts use to invest, they are saying that many stocks are very highly valued. So kind of pricing in best case scenario. And again, we believe that certain stocks will be able to carry through and certain sectors will be okay, but we anticipate a lot more volatility in Q4 in our portfolios. We've tuned down some of our exposure because remember, here at DBHW, while we strive to outperform and we're doing that on many levels, our biggest deal where we concentrate is what we call the ride. We want your investment ride or your investment experience to be less volatile than what the market is doing. So we are positioning ourselves that way. And again, what I would say here, slowing growth. We're kind of in the thick of earnings season right now. That's when companies report how they're doing, and we're paying close attention to that. For now, we remain slightly risk on. In other words, we're still, out there capturing some of this momentum, but we do believe that Q4 is going to bring probably a little bit of a deeper correction. Maybe not to the level we saw in April, but it could possibly happen. We do think Bitcoin will continue to thrive, but also there and also in gold, we could see some pullbacks as both of those assets have just gone straight up to the roof. But anyway, without taking too much of your time, hopefully that's been helpful. Look forward to meeting and talking with you guys as you come in for your annual and quarterly appointments and checkups with our great advisors. We look forward to seeing you guys. And remember, any questions, we're always open and available to talk. Have a great day. Happy trading, happy investing. We'll talk to you soon. Bye-bye.